in Africa, which has not reached the peak yet, and will not reach it even in 2050. So this correspondingly has impacts on the saving rates of the various regions, and you can see that some are decreasing faster than others. Notably, Sub-Saharan Africa saving rate is not going down. By the way, these are in terms of rates. In terms of amounts, China will still be the leading supplier of savings up to 2030, and India will become the second supplier of savings by 2028, surpassing Japan and the US. Again, as for the investment, even though the saving rates are reducing for both group of countries, because the developing countries have a much higher saving rate, and because they become more important in the world economy, the amount of savings available is not, for the whole world, is not going down. And for that reason, in this graph, you see we calculated when we match saving and investment, we are able to calculate a yield, and that is not as fairly stable. Here is even excessively stable, the dotted line, because it's the average of different countries. In some countries the yield will go a little bit more up than others, will go down, but on average we don't see much pressure on the investment rate. Let me finish off with the third question. Consistently, the majority of investors and majority of savers will be in the developing world, and so you say matching them shouldn't be a problem. Well, not really. They are not all in the same countries, and up to now, if we take one measure of the intermediation, which is in this graph the gross capital inflows, international gross capital inflows, the high-income countries dominated this industry. So there is almost no room for, or there hasn't been much room until now for developing countries. Again, this will change, and in the first scenario, the share of these capital flows will be almost half and half. Now note the following, that the intermediation, the financial intermediation sector in high-income countries took 50 or even 100 years to develop. Here, in the matter of 30 years, we have a dramatic change. So this is easily, it can happen in economic model, but it requires a huge transformation in reality. So bear in mind that. And in a scenario that is a bit more robust, with even more faster growth, they can go to 2/3 of that metric. Now, these are not outlandish projections. The exact same projection are seen here in terms of capital flows, gross capital flows as shares of GDP. And the one that shows the 50-50 share is the one that keeps the GDP, the capital flows to GDP at a low level of say 6%, if I read correctly. And so the other one that seems very strong goes to 11, but if I trace a trend, just an extrapolation of the recent trend, which is the gray line, it would be even higher. So I have discussed up to now how the investment will look like, where are the savers, is there going to be pressure on the savers, and the transformation in the global economy. I mentioned that this is not happening easily without policy intervention, and here we show, but I don't have the time, for the sake of time I will stop, we show a few policy challenges to reach that future. But let me, in conclusion, just say one thing that may help with the debate afterwards, and gets me back to the beginning of my talk. There was an interesting article just this weekend on the FT by Cardiff Garcia. The title of the article was Sluggish Growth Leads Company to Take the Short View. So in his article he just points out that among the various options that governments have to counteract short-termism, the best one is probably to help growth. Ultimately, companies will do invest if they believe they will have customers that buy their goods. And so it's not just a matter of having high profits or retained earnings. So this is very, very well with what I said at the beginning, that growth is a big driver. So I stop there. Thank you very much.
Thank you. I'm Tim Kohler from McKinsey. McKinsey has long been interested in the behavior of companies with respect to their short-term versus long-term behavior, which is one of the reasons why we've become one of the founding members of FCLT Global, which stands for Focusing Capital on the Long Term, with which Mark Weissman is the chairman and one of the founders as well. And I'm going to share with you some research that we've done recently to try to just quantify the effects of short-termism on a company performance, and then and then answering the question also, what's the source of that short-termism, or at least what might not be the source of that short-termism. So we've done some work, as you can see here, trying to develop an index of short-termism, and we reviewed it with academics and other experts around the world. Our conclusions are: one, long-term oriented firms do tend to outperform their shorter-term peers, their industry peers. Secondly, we don't think that it's because of investors, as is often blamed, the cause of the short-term behavior of companies. And secondly, we think that ultimately the solution has to come from more courageous CEOs and engaged boards to get away from the focus on the short term. So let me just share a little bit of our research first. So we put together an index of short-termism or long-termism, however you want to think about it, where we looked at 5 factors. And one of the things that we tried to do with these factors is make them non-intuitive. For example, you'll see that one of the factors relates to how quarterly earnings management, for example. So you think that a company, a company that actually manages its earnings to closely meet the consensus estimate is probably actually more short-term oriented than a long-term company that lets the earnings be a little bit more volatile. Another example, the third one, the reliance on margin growth. Is it good to keep on increasing margins? A lot of companies say that one of their goals is to keep on increasing their margins or to grow the bottom line faster than the top line. That isn't necessarily a good thing. In order to keep on increasing your margins, you often have to cut costs, which eventually come at the expense of long-term growth. So for example, just to give that was an example, we looked at what happened the longer companies increased their margins. And what we found was that the longer a company increased its margins, the more likely it was that its return to shareholders would be lower than its industry peers over the following 2 years. So cost cutting is good for up to a point, but once you've sort of extracted all the efficiencies out of the business, the only way to keep your margins increasing is to cut back on things like product development, brand building, other things that are important to growth and to the customer. So the metrics are sort of are trying to sort of come up with things that are not necessarily intuitive about what may be long-term versus short-term. Some of the results, we looked at 600 companies, we identified about 150 of them as long-term. Just to give you a sense of some of the results, we looked at revenue growth. Companies that were long-term oriented grew revenues faster. We looked at economic profit growth. Economic profit simply earnings minus a charge for capital. You can see the long-term oriented companies grew their economic profit faster. We also looked at employment. We found that on average, the long-term companies also increased employment more. And then finally, let's look at shareholder returns. We found that the long-term companies were 50% more likely to outperform their peers over the long term in total returns to shareholders than the short-term industries, relative to their peers. So there is clear evidence, we believe, that there is short-term behavior out there, and that the companies that have longer-term behavior actually will outperform on many dimensions than the short-term oriented companies. So it makes sense for companies to sort of focus more on the short term. One of the things that we often find is that we hear when we read in the press, we talk to executives, often they blame it on the stock market. Well, we're short term because the market pressures us to be short term. So we've been doing some research into the stock market and well to see whether or not that makes sense or not. One of the things we found first is that about 75% of a typical company's shareholders are long-term oriented. About 25% of a company's shares are held by retail investors, most of which are buy and hold. I read that wrong, 33%. Index funds hold another mid-teens, and that's growing. They're by definition long-term. And then we looked at institutional investors who account for about 50% of the rest, and we found that at least 25% of the shares are held by institutional investors with holding periods longer than three or so years. So we found that, first of all, if you're thinking about your shareholder base and you want to create value for your shareholders, if you're really interested in the bulk of your shareholders, you should be focused on longer-term value creation, not short-term value creation. We've also done some work interviewing some of these long-term investors. So what we did is we targeted a set of long-term investors, institutional investors, who we thought were very sophisticated. They had fairly concentrated portfolios, and we asked them a series of questions. I'm just going to show an example here to see how they would treat certain things. So we posited a number of hypotheticals. One hypothetical we asked was, suppose you're a company that earns 70% of your profits outside of your home country, in this case the US. The dollar strengthens, and all of a sudden your profits are going to be lower than expected for the year. What do you do? And we gave them three options and asked them to respond. First action, make no changes. Just report lower profits. Markets understand that you can't control currency rates. What we found was that you can see clearly that 25% viewed that positively and 63% neutral. So in other words, only 13% viewed that negatively. So the market doesn't expect you to do things you can't control. On the other hand, if you look at the bottom, we also asked as an action, ask all of your units to make across-the-board cost cuts, which is not as surprising as you might think. It happens all the time. And we found a much different response where 63% of the investors felt that that was a bad thing to do. So investors don't necessarily want you to take heroic actions in order to increase your short-term earnings. Interestingly enough, in a separate survey, we asked about 700 executives how they felt their companies would act. Not what they thought was the right thing, but how they thought their companies would react. And we got different answers. If you look on the left-hand side, you'll see that 37% of the companies felt that they would ask for across-the-board cost cuts. Reminds me of an example of I was talking to a CFO of a company. Their Russia business was down a couple years back because of Ukrainian sanctions and because of the dollar being down. Their immediate reaction to make up for the loss of income in the Russia business was to cut back in their most important growth markets, were in Southeast Asia. Okay. Clearly not going to be value creating, and clearly not consistent with the views of the investors. Interestingly enough, though, when we asked employees or executives at private companies, we found a different answer. So public companies seem to have this focus on meeting the short-term earnings at all costs, even though it doesn't seem to matter to investors and doesn't seem to create value. So one of the difficult things that we have to deal with is, how do we solve this problem? There have been a number of things suggested such as giving more votes to longer-term shareholders, ending earnings guidance, etc., those kind of things. We don't think that those things are going to change. Companies will always find ways around those things. And we found that, if you look at companies, you'll find companies with super voting shares who aren't necessarily more long-term oriented. You see private companies that aren't necessarily more long-term oriented. We think that the solution, we don't know what all the solutions are. We think that sort of two of the solutions are, one is you really need to see much more courageous CEOs who are willing to focus on the long term and not worry so much about what a small set of investors are going to say about them or what the press is going to say about them. And secondly, we need much more engaged boards of directors. Oftentimes, the boards of directors of large companies in particular just aren't close enough to the businesses to judge the business by anything other than short-term profits. So the boards have to be able to ultimately get to the point where they can understand, are the results that are coming in based on good long-term decisions, or is the management team just making their numbers by doing things that will eventually cost me in the end? And then, of course, finally, and I didn't put it up there, there is also a role for the institutional investors who are long-term oriented to perhaps speak up more, to make their voices known to the CEOs and the boards so that they feel more comfortable making those long-term decisions. Thank you very much.
Hi everyone, can you hear me? Excellent. I hope you are enjoying your lunch, and if you're just coming in, please take a seat. And as we say in Mexico, buen apetito, buen provecho. I would just like to tell everyone that one of the reasons that we have our guests over here is because some of their companies or their organizations are part of an organization called Focusing Capital on the Long Term, which is FCLT. And BlackRock, Tata, McKinsey, Dow, and the Canadian Pension Investment Board were part of the founding members, and now more than 35 members have joined the organization that looks to promote a long-term orientation on capital and on investment. And part of the results that have been presented by Mauricio and by Tim basically signal in that direction, the importance of having a long-term view on capital and on investment in order to be able to meet challenges in the private but also in the public sector. So with that in mind, I would just like to tell you that we have a very limited time. So we're going to start with an opening round of comments by Tim, Mukund, and Graham. And after that, we're going to move directly to a Q&A session. And I would like to ask you to please write down your questions and send them to me so that we can start addressing them as soon as we're done with the opening remarks. So please write down your questions in a piece of paper, and all of the volunteers that have a T-shirt maybe can help us sending the questions to the panel. So with that in mind, I would like to ask our panelists, starting with Mark, if they could share the perspective of their organizations on having a long-term capital orientation and what have been some of the advantages of using this approach. Mark, please.
Thank you. So I think the point that needs to be made is very, very important. And the reality is that every dollar, every peso, every yen, every pound, every euro in the world belongs to individuals. And I think Tim made this point from the macro level, from the point of the corporation. But if you go back and think about who owns capital, capital is ultimately owned, every single piece of it, by individuals. And those individual savers have a long-term interest. Why do people save money? They save money because, by definition, they want that money for the future. They want it for their retirement. They want it to buy a house. They want it to send their children to school. They want to provide for future generations of their family. So by definition, savers are long-term. They then give their capital to asset owners like pension plans, who engage with asset managers like BlackRock or others. That money is then allocated to corporations through the governance of boards of directors, and which is managed by executives, invested in projects. And then ultimately, if everybody's successful, that money comes back. But as Tim described, something happens. Something happens in that value chain. While the interest of the capital owner is long-term, the decisions that are made by corporations today, and in particular public corporations, are very short-term. And we know that those short-term decisions are in fact destroying shareholder value, destroying value to the savers, and indeed destroying prosperity and growth across the global economy. So the real question that we need to ask ourselves is, how do we reverse that trend? What are the factors that are causing us to be short-term, and how do we reverse the trend in order to drive a higher degree of economic growth? How do we invest more of our capital more productively in order to drive GDP growth? And I happen to think that this is one of the largest problems facing the global economy today. So BlackRock is very involved in this, as Noel said, the other groups that founded FCLT, and that's really the question that we're working on, and we think should be of deep, deep interest to economists both in developed countries but also in the developing world.
Thank you, Mark. And I just want to make sure that everyone in the back can listen to us. Can you listen to us in the back? Okay, well, I'll assume you can.
We're gonna cold call.
Exactly.
There's going to be a quiz at the end.
So we're going to move now with Mukund from the Tata Group. Mukund? Yes, please.
Thank you very much. I represent the Tata Group of India, which is now really a global diversified business enterprise. Last year we had a turnover of just over $100 billion. We employ over 700,000 people across the world. Next year we will celebrate our 150th anniversary. We have therefore been in business for quite a long time. In this period, for over the last century, for every decade of the last century, we have featured amongst the top 10 industrial groups in India, and we are now the undisputed #1 group in this country. What might explain the success of a group like Tata? We think there are at least two critical factors. The first is the long-term orientation of our leaders. In the last 149 years, we have had only 7 leaders, which makes for an average tenure of over 20 years for each leader. The other factor, we believe, is the founding business philosophy of the Tata Group. This is enshrined in a famous quote of our founder, Jamsetji Tata, when he said that in a free enterprise, the community is not just another stakeholder in business, but is in fact the very purpose of its existence. So we believe that to succeed in business, you need to integrate the expectations of the community and all the stakeholders in the community. In the Tata Group, the founders' 2 sons institutionalized this commitment by establishing charities through the bequest of their entire holdings in a parent investment holding company, Tata Sons. These are now the largest charities in India. They have made the communities a partner and a stakeholder in the Tata Group's success. The more surpluses we generate, the more is plowed back into the community through these charities. It is for that reason that we have now defined our core purpose or our mission as improving the quality of life of the communities we serve globally through long-term stakeholder value addition based on leadership with trust. I think the best example perhaps of what a long-term orientation can do to make a business successful is the case study, if you will, of one of our group companies, Jaguar Land Rover. We are celebrating now the 10th anniversary of the Tata acquisition of JLR. 10 years back, these were two brands that were on the verge of collapse. This was a company that had seen successive owners who were not necessarily committed to the long-term success of these brands. When we took over, we provided a commitment to the management that we were there for the long haul, and we backed that up by investing in the long-term product pipeline. We put in over $1.5 billion in supporting this company at a very difficult financial time for the world markets in 2008, 2009. That investment has paid back in spades. Over the last 5 years, this company has generated profits in excess of $15 billion. Compared to an investment we made of $2.3 billion, I think that's been a terrific return on investment. I think that's a very good example of what happens to a business when its owners are committed to really long-term success and to carrying the community with them. I think with that I will stop and happy to take questions in the next round. Thank you.
So just a quick reminder. Please send us your questions so that we can start addressing them once we're done with Graham's comment. So now, Graham Pitcatley from Unilever, please.
Thanks, Noel. Just a word about Unilever. If you don't know what we do, we're a big consumer goods company. We've been around for about a century or so. We're in 190 countries in the world, and we have brands which are bought by consumers in the world 2.5 billion times a day. So we reach about 2.5 billion of the 7.5 billion consumers on the planet every single day. And as any consumer company would be, we very clearly understand that the value creation in our business, if you like, the earnings growth and the cash flow growth that we have in our business, the biggest component of that comes from growth of the top line of our business. That comes from our brands, from our people, and from our infrastructure, and that requires that we consistently invest in our brands over time. So we have what we think of as a long-term, sustainable growth model which drives value creation, and that growth comes about from consistently investing in our business, and it delivers some pretty good returns. We've worked very hard to make sure that our investor base understands that and reflects that. About 70% of the investor base in Unilever has been in the stock for about 7 years or so, so it's quite a long-term focus. And in terms of the ultimate test of value creation, well, our dividend has grown by 8% on average every year for about the last 34 years. So we think we're okay, and we think our model is well understood, and we think our investor base understands that. So you'll understand our surprise when we were subject back in February this year to a hostile takeover bid. In fact, a takeover bid of such scale that had it gone through, it would have been the second largest corporate takeover in history. So that has caused us very much in the business to think about the long-term nature of our business model versus other business models and other variations of that model that might deliver a higher return in the short term but not be so sustainable for the longer term. And it's not often that you get the chance to go through a situation like this and actually reach out and talk to around about 45% of the market capitalization of your business, and we're a 140 billion market cap company, so that's quite a lot of capital that you're talking to. So we were pleased because we had a great reaffirmation of the long-term nature of our business, but what it did bring into focus for us is very much the things that Mark and that the research that Tim has done bring into bearing. It's very clear that capital starts out being long-term by its nature, but something happens in the gearbox of translating that for public companies that means that increasingly things become short-term. Now, I could speculate around a couple of things there. I think that the increasing amount of passive investment that exists in public companies means that disproportionately there's a higher role on active investment and even activism, and I think that activism becomes a very, ultimately a very short-term demonstration of value creation, and that question of long-term and short-term value and investment can be a real focal point of activism. And secondly, I would say that there is something around the role of sell-side analysts in the marketplace, because that's where the noise and the headlines are. Because I very much agree, I don't think there's much wrong with investors here, because all investors start out long-term, but something happens in the gearbox, something changes when it's applied to public companies, and that's why the work of the FCLT is just so fundamentally important, to ask ourselves, what is it that has to happen in the executive teams and indeed in the boardrooms of public companies to have the confidence to maintain a long-term investment-driven model, if that is the model that is in fact best for your business and generating a superior return over the longer term.
Thank you, Graham. Following up on that comment, I would like to ask our panelists, I mean, we know that there's a problem, right? And FCLT has been working a lot on this. But from your experience, can you share with us measures that your organizations have taken in order to switch your organization's focus from short-term to the long-term? So that the behavior, how do you achieve this behavioral change? So let's start with Mark.
Well, I want to pick up on Graham's point, which I think is a very important one, which is the nature of shareholders today. And I think the reality is that a lot of shareholders aren't acting like owners. If you talk about some of the statistics that Tim showed in his work, the difference between private companies and public companies, a lot of that is the nature of the shareholder and how the shareholder behaves. Now, interestingly, those index shareholders, which Tim showed is at about 17%. I think the number in the US is even higher, now approaching about 30%. Those are in many respects the ultimate long-term owners. Because if you're managing an index like BlackRock does for over $2.5 trillion, you can't sell your shares. So the only way that you can benefit your clients as a fiduciary is actually to grow the size of the pie. But in order to do that, shareholders have to start acting like owners. They have to start engaging with the companies they own, and they have to, in effect, make sure that those companies are held account to the long term. You know, how is it that an activist investor with 2.5% or 3% of a company's stock, I don't know what it was in the case of Unilever, but it probably would have been around that amount, is able to essentially change the direction and change the outcome of a long-term corporate strategy? And I think the problem is, where is the other 97% of shareholders? How are they behaving? How are they demanding that the companies that they own, as the owners of those companies, deliver on that total shareholder return in the long run? And so I think it's incumbent. In BlackRock, we're spending an increasing amount of time, especially in the index side of our business, actually engaging with the companies we own and demanding, for example, and you saw this in our CEO Larry Fink's letter, demanding that those companies start being more long-term, set out their long-term strategy, report on metrics against that long-term strategy, and show what they are doing for their ultimate owners, which are ultimately those savers that I talked about earlier. But until the owners of companies start demanding that the companies that they own act long-term, then 2 or 3 or 4% holders are going to be able to swing around company strategy in order to make short-term gains to the detriment of the other vast majority of shareholders.
Thank you, Mark. Tim?
Yes, just to build on what Mark said. Can you hear me?
Yes.
Just to build on what Mark said, I think also one of the things that we try to convince companies to do is, one is to become, to not sort of pay so much attention to the sell-side analysts. The sell-side analysts tend to dominate the quarterly calls, and therefore executives tend to assume that they represent the market, when our research shows that that's not at all the case. And so I think a big opportunity, what we encourage executives to do is to really figure out who are the core intrinsic investors in their company that they should cultivate relationships with and that they should spend the time. Because these investors are often investors who they're betting for the long term, they're betting on management. If they see a short-term weakness in the stock price, they'll often use that as a buying opportunity. They can also provide valuable intelligence. So I think that if executives get smarter about which investors they talk to, they communicate to, they listen to, they'll feel more comfortable making the long-term decisions that they should be making.
Thank you, Tim. Mukund?
So in my opening remarks, I talked about the importance of leadership and the importance of an organizing philosophy, business philosophy, a core purpose of the organization, which demonstrates the commitment to the long term. I think those are critical elements. But moving beyond that, I think you also need to have a way of incentivizing your leadership teams, your management, and also a way of measuring progress and reporting it to the markets. So in Tata, we have two elements that are quite critical. The first is what we call the Tata Business Excellence Model, where we measure companies on their performance to certain benchmarks, and 93% of the measurement is really around processes, systems, leadership. Only 7% is the focus on short-term financial returns and performance. So we try and inculcate that spirit in our leadership teams, and then that gets reported to the public markets. We are still in the early stages of the journey. We are, for instance, along with Unilever, part of some of the reporting initiatives, including integrated reporting. So we're trying to test these models of disclosure, which would hopefully then educate the investor base and get them to task us to do better for the long term as well.
Excellent. Thank you. And Graham?
Just a couple of short builds. I think it's very important for the leader of a company to express within the company very clearly the way to think about returns and the way to think about the stakeholders who are associated with the company. Now, we have always said that, and we're quite, we don't apologize for this. We've said we run our business for the benefit of our consumers, first and foremost. We unashamedly put them highest in the pecking order, because we know that if we run the business and our consumers benefit, then ultimately we will have a better business and all of our stakeholders will benefit, including our shareholders. But sometimes that can be controversial, particularly when you're in a takeover battle and the question of shareholder value comes much more into focus. I do think that there are some stark differences in the fiduciary responsibility of boards, legally, country by country, and just clarifying that and allowing boards to think more broadly about a broader stakeholder set naturally takes them into a more long-term and thoughtful way of their thinking about their stewardship of the business. And finally, just to build on a point made earlier, I think when investors, particularly as Mark said, index investors, have a dialogue with companies, ask them about the quality of their delivery, the quality of growth, the quality of earnings. All companies think about this every year anyway, because in internal remuneration assessments, the quality of the result is as important as the result itself. So the information is there. Just ask the question and you'll learn a lot more about, how good the result really was.
Excellent. Thank you. And we have 5 minutes left, and I would just like to ask the speakers to give us their last comments. But I would like to also ask a very specific question. Given that we have a group of economists from very many different parts of the world, and that a lot of their area of research has to or is related with public policy and how it affects development also, I would like to ask you, what would be a way to also cause this shift in behavior from the short term to the long term from a public policy domain, especially so that it can promote development?
Well, I think this is a key question, and I think, first of all, that economists need to pay much more attention to this issue. Economists are so focused on GDP growth, on development, on lifting those countries and those communities which are most in need to come up to global standards. And if we start thinking long-term about those issues, it's my belief that from a public policy point of view, it's my belief that we'll get better growth and better long-term results. You know, if you think about it, the global financial crisis was by and large driven by the fact that there was so much short-term behavior in markets. Yet, in now the 8 years since that crisis, we've had so many regulatory and policy impacts that have had the unintended consequence of making the world even more short-term. This is issues around accounting standards, it's issues around reporting. You know, something as simple in Europe, if you want to look at something like the Solvency II standards, which basically make it very, very hard for insurance companies and pension funds to own longer-term dated assets, and the impact that that has on those type of asset managers' ability to invest in longer-term projects that develop growth and can, in part, help develop growing economies. So I think not paying attention to this issue, both from the corporate point of view, but also from the public policy point of view, we do so at our peril.
Thank you, Mark. Tim?
As I said in my remarks, I'm skeptical about the ability of governments to try to solve these problems through regulation, particularly through voting rules and those kind of things. One area where there might be a benefit, though, is if there was a way for the accounting standards to encourage companies to give information that helps investors understand more the quality of earnings as opposed to just what that bottom line number is. And I think that there are probably some ways to do that. It might be a little bit different, but you know, sort of somehow relating things to, for example, growth to investments in new products or branding or whatever, to try to make a connection between what is the company doing and how its margins change and how that contributes to growth or not. I'm not sure exactly how that would work, but something along those lines might be helpful.
Mukund?
I don't think I'm going to have an answer to your question, but I can certainly suggest some further questions that need to be deliberated upon. If I look at India as a case study, we have over 1 million young people entering the workforce every month. The level of unemployment, if it is not addressed in the near term, is going to create a major social catastrophe. And this morning we heard the focus on inequality. As inequality builds up, if you have a large unemployed population, you have the makings of potential social strife. So I think you need to have answers in the long term for what you're going to do about employment opportunity, in India particularly what you do about gender equity. And the third question is, what are we going to do about the problems that climate change and the environment are posing? If we don't act now to address these in the long term, we're all sitting on major catastrophe. So I think there is a huge role that public policy will play in moving the narrative in the direction of solving these. What exactly can be done, I think, will be a function of each stakeholder coming forward and promising the best that they can offer.
Okay. Thank you. And Ram?
I'm very much where Mukund is, as you'd expect me to be. I mean, we're big fans of integrated reporting, encouraging companies to talk in their annual filings more broadly about the totality of their business strategy, and in particular bring the long term in. The reality is that a lot of financial filings are incredibly short term in their nature, and there are a number of legal perils in different parts of the world that prevent management teams and boards from disclosing more robustly some of the risks and opportunities that they face as a result of things exactly like climate change or mass migration, a lack of diversity in their business, etc., but which are actually much more important from the perspective of providers of long-term capital when they think about the health of the business and how that investment is being stewarded by the board.
Right. Excellent. Thank you very much. And well, with this we come to the end of this very interesting panel. I would like just to take the chance to say thanks to the Tata Group for hosting this session, and please join me with a round of applause for all of our speakers and panelists. Thanks.
Well done, Mukund.
Good job.